Today we'll be mainly talking about the relationship between inflation and employment, and that is known as Phillips Curve. We touched upon this in lecture 2, if you remember. We talked about Phillips Curve and the inverse relationship between inflation and unemployment rate. But today we will give it more thought, and we'll talk about it in more details. So what I want to do next then, give a little some background of Phillips Curve and how it started, and then we'll fast forward. We'll move forward to how we understand Phillips Curve today. So in 1958, Phillips found that there is a negative relationship between the unemployment rate and the rate of change of money wage rates. As you see, this graph was taken from his original paper, published in 1958, and this data for the UK. So basically, the original relationship which was proposed or observed by Phillips in 1958 was mainly for UK data, and showed that there is a negative relationship between as you can see, between the unemployment rate and the rate of change of money wage rate. So Samuelson and Solo in 1960 labeled this relationship which between the inflation and the employment rate and inflation rate by the Phillips curve. So they show that, okay, so this relationship seemed to hold at the time hold in other countries too. So it became very popular in economic analysis in the 1960s. So this, for example, here, what you see on the graph now, you see this is data for the US, not now for the UK. So the original one, or the original paper, was mainly for the UK, but this one for the US show that there's an inverse or a negative relationship between inflation rate on the vertical axis and employment rate on the horizontal axis, and it seems that a low level of unemployment rate is associated with a higher level of inflation rate. So as I said, this relationship became very popular at that time, and it became central to macroeconomic thinking and policy. And the idea here is that if you want to get rid of unemployment, or if you want to reduce unemployment rate, then you have to accept a higher level of inflation rate, and that is the whole idea here. So how this was built, or what is the rationale behind that? So as I said, the whole idea here is that, or looking at the original Phillips curve of 1960s, the idea is that there is a simple and stable trade-off between the inflation rate and the unemployment rate. So if you want to achieve a lower level of unemployment rate, then this has to come at the cost of a higher level of inflation, and vice versa. So if you want to lower inflation, then you must accept a higher level of unemployment. And the idea here was that if you, for whatever reason, the aggregate demand, maybe there's an expansionary policy, or as a result of an expansionary monetary policy, the aggregate demand has shifted to the right. That means now higher demand, and that for firms and businesses will respond to that by increasing their demand for labor, and increasing demand for labor would mean that the unemployment rate will be lower, or will drop. And then if the unemployment rate is lower, so that means, which we discussed this before when we talked about labor markets, we said at good times, during good times when the unemployment rate is low, then firms compete to attract workers, and that to do that they need to offer higher wages, and higher wages, if of course would mean, because this is cost for firms, so if they pay higher wages, that means they will also that will translate into higher prices. And you can see now from this, or the rationale here, or the idea here, is that low unemployment rate will be associated with a higher level of prices, or higher inflation rate. So for some time, macroeconomic policy was mainly to choose where's the mix you want. So where do you want to be in that relationship? Do you want to, how much unemployment you would like to accept, or you would accept, or how much inflation you would accept if your target was to reduce the unemployment rate? Okay, so but that kind of then you can just design your policy, whether monetary or fiscal policy, to achieve that target, and knowing that you must accept higher inflation if you want to lower unemployment rate, or the other way around. Okay, so but this hasn't lasted for long, because that whole original Phillips curve idea, which refers to the stable trade-off between the inflation rate and the unemployment rate, was all like brought to question by what happened in 1970s. And we discussed this before when we started talking about the aggregate demand and aggregate supply model. We explained what happened in 1970s. We talk about, when we talk about supply side shocks, so when we talk about supply or oil price shocks, and we explain what happened in 1973 and by the end of late 1970 as well. So how oil prices have increased, and that put the whole relationship into question, because the economy entered stagflation, where you had both. You had high levels of inflation and high levels of unemployment. So it seems that sort of inverse or negative relationship between inflation rate and employment rate kind of broke down, because it no longer exists. So, and Milton Friedman explained that, and he said that the nature of the Phillips curve relationship would change if we start thinking about the expectation. So if expectation change, and as we said before, then stagflation called a question into the validity of the Phillips curve idea itself, and some models or some economics will even put some question about whether it would hold or not. So what we want to do next then, so let's see how we can present what is known now as the modified Phillips curves, because what we explained, and as I said, this is like part of history. What happened in the past is that 1960s, that was kind of important relationship in macroeconomic policy thinking, but then moving toward 1970s and afterwards, there were many questions about the validity of this simple and a stable trade-off between inflation rate and unemployment rate, and we'll see how this has changed when we added expectations, when we brought expectations into the picture. So we brought expectations about inflation rate, and also we would need to consider or take into account or take into consideration any supply shocks as well. Okay, because the main issue with the 1970s was the supply shock or oil price shocks that took place in 1970s, and that draw the attention to the importance of considering supply shocks when trying to understand the Phillips curve, which was called later the modified Phillips curve, or expectation-augmented Phillips curve. So let's have a look at what that means and how it looks like, and how that is linked to the short-run aggregate supply curve. Just to show you the equation, it's much easier if you know where we're going, where we're heading first. So you see the destination yourself before we see on the map where we're going or how to get there. So this is what is called now the Phillips curve, and what it tells us here, it tells us the inflation rate pi depends on expected inflation. So now we have expectations, remember? So that's what we said. We said it's important now to consider expectation when you talk about when you discuss Phillips curve. So which we call the expectation-augmented Phillips curve, or the modified Phillips curve. So this is slightly different from the idea that appeared in the 1960s. And as I said, the main reason, 1970s, there were supply shocks, we had stagflation, and that put the symbol and trade-off relationship between the inflation rate and unemployment rate into question. And then people start thinking about how we may understand this in a more realistic way. So bringing expectations into the picture will will show us how that what that means to the Phillips curve. So in this equation, as I said, this is the destination, and I'll show you in a few seconds. I'll show you how to get to that destination, how to drive this equation using what we learned about the short-run aggregate supply curve, how we can drive this equation from the aggregate supply curve relation. So what do we learn from this equation here? As I said, so the inflation rate depends on the expected inflation rate, and also it depends on the cyclical unemployment. So it's very important here to hold on for a second here and remind you what we when we explained cyclical unemployment and the natural rate of unemployment, which is here UN. So on in here this sober script here in. So this is the actual unemployment rate, and this is the natural rate of unemployment. And as we said before, if the cyclical unemployment equal 0, then the actual unemployment rate equal the natural rate of unemployment. So that means these two are the same if cyclical unemployment equals 0. So it makes sense if we define cyclical unemployment as a deviation of the actual unemployment rate U here from its natural rate. So at the natural rate, we're looking at the full employment output level. We're looking at the Y, or the output, as its natural rate. Okay, and that gap between the actual unemployment rate and the natural rate of unemployment rate represent the how much or how big or how large cyclical unemployment is. Okay, so this is very important. So that could be positive or negative, this gap. So it could be smaller, or could be 0 if the actual unemployment rate equal the natural rate of unemployment rate. We also just said now that we should consider supply shocks. So that's why you will see this this letter here, this Greek letter nu here. So this is this to refer to supply shocks, such as oil price shocks, as we explained before, and B here is just a parameter or an exogenous constant. So moving from here, then, as I said, this is our destination, so I don't want people to get lost when we try to drive this. So moving from here, we start with the short-run aggregate supply equation. So looking at this, again, we have short-run aggregate supply equation. We have output is determined by this level, and the gap or the difference between the actual price level and the expected price level. And if the actual price level tend to be the same as the expected price level, this will cancel out, and that means we will be at the full employment output level, or in other words, the natural rate of employment, or natural rate of unemployment, or natural rate of output. So these are all the same. And at that point, if you remember, we said the natural rate of unemployment equal the sum of the frictional unemployment and structural unemployment. So we explain what we mean by frictional unemployment and structural unemployment. So it's very important here to understand, and I said that many times, I know, but I'll keep repeating that. The natural rate of unemployment doesn't mean that the unemployment rate equals 0, but rather it's equal the sum of the frictional unemployment and the structural unemployment. Okay, so in that case, we explain what frictional unemployment is. If you remember, frictional unemployment, when people move between jobs, so they spend time unemployment looking for jobs or getting ready to join a new job. So that time is while they are employed. This is part of labor market dynamics. People leave jobs and join jobs, or start new jobs. So that is frictional unemployment. While structural unemployment is the mismatch between skills. So we have jobs that require certain type of skills, and we have workers with different type or different skills they're looking for jobs. So maybe they need some training, they need to do some more whatever just to join the new job. This is the structural unemployment. But cyclical unemployment is different, because cyclical unemployment it's due to a shortage in the demand for goods and services. So that's why. So what you see here is, or what you saw in the in Phillips curve here, in this curve here, is the difference between the actual unemployment rate and the natural rate of unemployment rate. So if that was 0, so if the actual unemployment rate was exactly at the natural unemployment rate, that means cyclical unemployment rate equals 0, and the actual unemployment, or the natural unemployment, or natural rate of unemployment, equal the sum of frictional and structural unemployment. So going back to what we started, we just wanted to derive this equation. We started with the short-run aggregate supply equation. We explained that last time, what that means, and we tried to explain more today about the difference between the natural rate of unemployment, frictional unemployment, structural unemployment, and cyclical unemployment. So if you solve this equation here, because we want to reach something close like this, so we want prices or inflation on the left-hand side and unemployment on the right-hand side. So so far what we have here, we don't have unemployment yet, but we have in this equation we have output. If we solve this for P, or for price level, so the price level in the left-hand side, and then everything else goes to the right-hand side, and that would give us this expression here. And you'll see that, okay, so price level, or the price, depend on expected prices, and the gap between the output gap, which is the gap between the actual output, which is Y here, and the full employment output level, which is Y bar. So remember, Y could be when we talked about economic fluctuations, and we use the aggregate demand, aggregate supply curve to explain these fluctuations, and what policy measures can be taken to address these fluctuations and stabilize the economy, or helping the economy, pushing the economy back to recovery. We explained that we could have an inflationary output gap, or a recessionary output gap. So if the actual output was above, if the actual output was above the Y bar, or the full employment output level, that means we have an inflationary gap. So that means there is a higher demand, which will put some pressure on prices, which will upward pressure, of course, and that will push prices up. This is something we explained when we talked about the aggregate demand and aggregate supply model last week. So remember now, so if this was positive gap, or meaning that the actual unemployment was higher than the Y bar, or the full employment level, that means full employment output level, that means that we have an inflationary gap, so we push prices up, and that means P, or the price level, will increase. And the other way, it could be the other way, where we have a negative gap, which means that the actual output here, Y here, is below the full employment output level, and that would be a recessionary gap. So anyway, so since we understand now that when we analyze this relationship, we need to consider shocks, supply shocks. So what we're going to do here, we're going to add a supply shock term that we saw in this equation, because we know that, okay, so this relationship here is not an exact relationship. There must be some sort of shocks, or supply shocks, that can push prices up if it was an adverse or negative supply shock, not a favorable supply shock. So what I would say here, which we explained again, which explained before, mainly when we define supply shock, unexpected changes, and that push the or unexpected events that push the prices or the costs of production up, which raises prices as well. And that means again, we need to consider or adding this term here, the supply shock term, to this equation makes sense, because because we know that if prices of if there was for example an oil supply shock, that means we'll push prices up. Again, a similar situation we are experiencing at the moment, which is the outbreak of coronavirus. If that cause a major disruption to supply and to production to businesses, so we should imagine, or we should expect prices to go up as well, again as a result of a negative supply shock. And again, it depends on what is going to happen there. The situation is moving very fast, and no one knows how this will end, but hopefully it will end soon. But as I said, if that was the case, then that we should expect prices, or this is a very expected or very likely outcome, where you have a negative supply shock, and that would increase or would push prices upward. So moving from here, then we know, okay, so this is the same relationship. So I didn't make any changes. I just wanted to show you this, where we are now at this point. So what we need to do now, we're not concerned with the prices. We are concerned with the inflation rate. So as you see, going back to the destination where we want to go to the inflation rate. We want to have an expression of the inflation rate and its relationship with the unemployment rate. So going from here, we would just subtract last year's prices. Let's call this PT minus 1 from both sides. So if this was PT, our price level in time t, and this price level in time t minus 1, and that again would apply to the expected price level. And just collect these together between brackets. So all what I did is just subtract PT, our prices in previous year, from both sides, but just collect these in those brackets. So from here we could say, okay, this looks like something very similar to the inflation rate, but notice that just before we leave this point, that this is not exactly, or the change in prices, not exactly inflation rate, unless the prices were expressed in terms of their natural log. And this is something we discussed before when we talked about in one of the tutorials. I think it was tutorial 2. We talk about how we explain the difference between the natural logs. So anyway, so if we express these, if these were expressed in natural logs, so that means definitely the difference between these two is the inflation rate, and from here, so the difference between the expected price level and the price level in time t minus 1, this would give us the expected inflation rate. So this is exactly, so this equation here is exactly the same as this equation here. So the main point here is that we're looking at the inflation rate, and here depends on the expected inflation rate plus some kind of constant here. And what we have here is the gap, or the output gap, as we explained before, the difference between the actual output and the full employment output level, of course, plus some sort of shock. So from here, then we build a relationship, or we drive the relationship between the inflation rate, the expected inflation rate, and output gap plus some supply shock. So remember when we talked about the natural rate of unemployment, and we talk about the relationship between unemployment and GDP, or output level. This is something we covered in lecture 2 when we talked about different macroeconomic variables. We discussed the negative relationship between Y, or between output level, and the unemployment rate. So again, just to remind you, in good times, we would imagine that the unemployment rate will fall. In bad times, in recession time, in difficult times for the economy, we would imagine that the unemployment rate will be higher. And that's exactly what we discussed when we talked about Oken's law, and that is the deviation from, or deviation of actual output level from its natural rate inversely related to cyclical unemployment, which we can then replace this part here, or this term, by this is kind of, okay, this is a constant which is equivalent to this one, and then we have the gap between the actual output level and the full employment output level, which is exactly or similar to, or it's inversely related to the cyclical unemployment, which is the distance or the difference between the actual unemployment rate and the natural rate of unemployment. So that means if you substitute this here into this equation here, that will give us exactly what we were looking for, or what we were hoping to achieve here. So what we have here is mainly the inflation rate depends on the expected inflation rate, and this is, as I said, this is some kind of constant or parameter, exogenous parameter, and then we have the gap between the unemployment, the actual unemployment rate, and the natural rate of unemployment, plus some sort of supply shock. So just to let you know, okay, so this is again, this is what we would call the expectations-augmented Phillips curve. Since we see expectations here, so we build the whole analysis here on we accounted for expectations, but this is different from the original 1960s Phillips curve, as we explained before. So it was very simple in 1960s. If the expected inflation rate was 0, or people didn't expect inflation rate to be high, let's say they expected inflation rate to be very, very small, you will see that if that means this nearly 0, so that would give us and of course, if you ignore that, supply shocks can play an important role in determining the inflation rate. So that would give you the straightforward, the stable, the trade-off relationship between, or the negative relationship between the inflation rate and the unemployment rate. So again, if people would expect, they don't expect inflation to rise, so the expected inflation is very tiny, is very small, is almost 0. And then if you just ignore supply shocks, that would result in inflation rate depends on this part here, which is exactly what the 1960s relationship between the inflation rate and employment rate was referring to. So this is kind of the original, or very, very close to the original. It's not exactly the same, but it's very close to the original Phillips curve or relationship that was observed by Phillips in 1958 and was confirmed by other people afterwards. So anyway, so that is again, that is how to derive Phillips curve from the short-run aggregate supply. So just, I don't want people to get lost. So what we started with is some historical background on what is Phillips curve, what do we mean by the Phillips curve, how did it start. We show this is from the original paper, and by the way, the paper is cited in the references at the end of these slides. So if anyone would like to read the paper, and also the other paper by Samuelson and Solo, 1960, again, it is cited at the end, or it's referenced at the end of these slides. So you can follow the papers online, and you can read the papers if you want to. But this was the original relationship for UK data, and that was compared to, also we compare this with the US data here, showed some similar trend. And again, just remember, this was data from 1960s, but then we said the whole relationship was kind of broke down in 1970s because of stagflation, or the stagflation we saw in 1970s, where we saw both the inflation rate and the unemployment rate were high. And later on, that Phillips curve concept was augmented, was modified by including expectations and also accounting for supply shocks, which something very clear, or was very important, or the events in 1970s show how important these shocks are. in determining, of course, the inflation rate. So from there, we show the what we call the modified or the expectation-augmented Phillips curve. So we show the destination, and what it tells us. It tells us the inflation rate depends on expected inflation. It also depends on cyclical unemployment, which is the gap between the actual unemployment rate and the natural rate of unemployment, and it also depends on some kind of supply shock. And from here, so all what we did just explained how we can derive that from the short-run aggregate supply curve. So that summarized everything we said. So all what you need to do if you want to drive this from the short-run aggregate supply curve, and from here you solve for B, and then you introduce the supply shock term, and then from here you could just subtract the last year prices from both sides. That would give you the inflation, and we explain why that is the inflation if these P or these prices were expressed in their log form. And relying on what we learned in lecture 2 about Okun's law, that negative relationship between output and unemployment, and that can lead us, or that took us to the full equation, or what we call the modified Phillips curve, or expectations augmented Phillips curve.